Most traders step into the market armed with charts, indicators, and endless hope, but very few realize the real opponent isn't the screen in front of them. It's the illusions they bring with them. You watch candles rise and fall, convinced that certainty hides somewhere in the lines you've drawn, yet every flicker of price reflects something deeper: your own fear, your own stubborn belief, your own hunger for control. The paradox is cruel. The harder you grip, the more it slips away. The tighter you chase, the faster it punishes you. But in the instant you let go, in the moment you stop playing like the gambler throwing chips across a crowded table and start thinking like the casino that quietly collects, everything begins to change. The market does not test your intelligence, it mirrors your psychology. It amplifies your discipline or exposes the lack of it. This is not about predicting tomorrow's price. This is about unmasking the illusions that drive your choices, the invisible strings tugging at every decision. Welcome to Trading Psychology Stick, the place where we dive into the hidden mental game that separates consistent winners from everyone else. And a quick but necessary reminder: none of this is financial advice. I am not here to tell you what to buy or sell. I am here to help you see the truth about yourself, because once you master your mind, the market stops being your enemy and becomes your mirror. Every trader dreams of the perfect system, the magical set of rules that will deliver profits day after day. But here's the bitter truth: the system is never enough. The gap between what a method promises and what a trader extracts is the silent killer of accounts. This is the profit gap, and it devours hope faster than any bad market. Picture a young trader named Daniel Reyes, wide-eyed and eager, who stumbles upon a strategy boasting a 60% win rate. He backtests it diligently, runs paper trades, even watches others succeed with it. Confidence surges, but when he takes it live, his results collapse. Winners vanish too soon, losers grow monstrous, and that beautiful 60% edge dissolves into nothing. He feels betrayed, abandoned by the very method that looked so promising. Yet the truth is plain: the system didn't fail him. His psychology did. The market is not a machine that rewards intelligence. It is a mirror, magnifying discipline or revealing its absence. Think of a basketball player standing alone at the free throw line. In an empty gym, he makes the shot 1,000 times. But when the crowd roars, the clock ticks down, and the championship hangs in the balance, his knees lock, his hands sweat, and the rim seems to shrink. Skill is there, but pressure changes everything. Trading is no different. Your technical setup is the shot. Your psychology is the pressure. Without inner control, your outer skill collapses under the weight of fear. Mark Douglas called this obsession with winning the illusion of control. Traders convince themselves that if they study harder, add one more indicator, read one more book, they'll find certainty. But certainty in markets is a mirage. The charts do not reveal the future. They reveal only how well you can execute your edge without fear, hesitation, or hope. And within this illusion live three dangerous lies. The first is that markets are predictable machines. We draw lines, measure ratios, and memorize patterns, fooling ourselves into thinking we know what happens next. But the market is not mechanical. It is alive, pulsing with human emotion, constantly shifting and refusing to be pinned down. The second illusion is that intelligence equals profitability. You've met brilliant analysts who can explain every indicator, every macroeconomic report, every nuance of supply and demand, yet when it comes to pulling the trigger, they freeze. Knowledge without discipline is useless. Markets reward consistency, not IQ points. The third illusion, the most poisonous of all, is the belief that you must be right to make money. This need to be right is the seed of every destructive habit. Moving stops, averaging down, cutting winners, revenge trading after losses. It creates the perfect conditions for self-destruction. And every time you give in to this need, the profit gap widens, swallowing your potential whole. Ask yourself honestly, how many times have you written in your trading journal the same mistake you swore you'd never repeat? How many times have you hesitated on a perfect setup or watched profit evaporate because you couldn't let it run? That is the profit gap staring back at you, mocking your knowledge, daring you to bridge it. And the bridge cannot be built with more indicators or strategies. It is built with psychology, with the courage to accept uncertainty, the humility to follow rules, and the discipline to execute without hesitation. But here is the good news. The profit gap can be closed. It starts not with mastering the charts, but with mastering yourself. When you accept that markets are random but not chaotic, that price is shaped by belief, and that your job is not to predict but to execute, you step out of the gambler's seat and into the casino's chair. The illusions fall away and you begin to trade with clarity. You stop demanding certainty and start thinking in probabilities. You stop fighting the market and start aligning with it. And slowly, trade by trade, you close the gap between what your system can deliver and what you actually achieve. That is where consistency begins. What if I told you that every single trade you take is nothing more than a coin flip? You might protest, but my system has rules, my charts have signals, my analysis is solid. And you'd be right. But here lies the paradox. Even if your coin is weighted, you cannot predict the exact sequence of flips. This is the cruel but liberating truth of trading. Every trade is random, yet over a series of trades, patterns emerge that form your edge. Imagine a coin tilted so it lands on heads 70% of the time. Over 100 flips, you can be nearly certain that heads will dominate. But can you predict the very next flip? No. It might land on tails 5 times in a row, then swing back to heads. The short term is chaos, but the long term reveals order. This is where so many traders lose themselves. They treat each trade as if it must win, demanding certainty, and when the market defies them, they feel betrayed. But randomness is not your enemy. It is the very environment you must embrace to succeed. Once you accept this, fear loses its grip. You stop obsessing over the outcome of a single trade and start focusing on the curve of many. The roulette wheel doesn't remember its last spin, and neither does the market. The casino knows that with a small edge, consistency is inevitable over thousands of outcomes. So why not think the same way? Why not become the house instead of the desperate gambler at the table? And price. Price is more than random. Price is alive. It is belief made visible, a raw projection of collective human psychology onto the screen. Every tick, every surge, every collapse is nothing but millions of minds colliding in real time. If you can't see this truth, you will keep treating price as a machine obeying your lines and indicators. Picture this. A stock rests at support. Traders crowd forums, whispering that this is the perfect place to buy. Technical analysts point to Fibonacci levels, moving averages, perfect confluence. But across the city, a fund manager decides to liquidate millions of shares in one click. That single action blows through all the levels, erasing the illusion. It wasn't your lines that failed, it was human intention, larger and louder than yours. Mark Douglas reminded us that every price is nothing more than agreement, buyers and sellers meeting in belief in that instant. Tomorrow, that belief may vanish or even flip entirely. You are not trading an instrument, you are trading a shifting consensus, a living marketplace of fear and greed. Imagine an open bazaar where one seller shouts, "Apples for 5," another counters, "4.50." Buyers gather, hesitant, waiting. Suddenly, a wealthy merchant sweeps in, buying everything at once. The price spikes instantly, not because of the chart, but because of the collective psychology colliding in that moment. That is price. Alive, shifting, human. Take a moment and look back at your last 5 trades. Were you focused on each individual outcome, praying it would win? Or were you thinking about your edge across the next 50? If you're honest, you'll see how often fear tied you to one result. That obsession is poison. Write this down now. I will think in probabilities, not certainties. This single commitment will transform your trading forever. Because once you accept randomness, you become free. Free from the illusion that you must be right. Free from the fear of loss. Free from the paralyzing weight of expectation. Think of a casino again. The roulette wheel has no agenda. Each spin is independent. The house doesn't panic when a player wins 5 times in a row. It doesn't chase losses. It doesn't celebrate streaks. It simply spins again, confident in its edge. That is the mindset of a professional trader. Calm, methodical, detached. No obsession with a single hand, only faith in the math over time. If you can step into this perspective, the market's randomness no longer feels like chaos. It feels like home. And here's the paradox that will save you. The less you demand certainty, the more consistent you become. The moment you stop clutching at the market, it stops punishing you. Fear thrives on your need to control. But when you breathe into uncertainty, when you release the outcome, You trade with flow. You stop being the gambler gasping for the next win and start being the house, steady and unshakable. Because trading isn't about predicting the next tick, it's about playing your edge over the long run. Accept randomness, embrace belief, and you'll find the freedom that gamblers never touch. Every trader begins with the same unspoken hope. If I study enough, if I prepare enough, if I am smart enough, I will always be right. And in the beginning, being right feels intoxicating. The market moves in your favor, your analysis is confirmed, and for a moment you feel like a prophet who can see the future. But then the market turns. Suddenly, you are not just wrong on a trade, you feel wrong as a person. Your ego bruises, your identity trembles, and the most dangerous trap of all slams shut: the need to be right. Mark Douglas warned that this obsession is one of the greatest psychological barriers a trader will ever face. Because once every trade becomes a referendum on your intelligence, your worth, your identity, you are doomed to self destruction. A losing trade is no longer just a number on a screen, it feels like humiliation, and humiliation demands defense. You argue with the market in your head, convincing yourself that price must turn back, that you can't possibly be wrong. But the market doesn't hear your arguments. It only moves, indifferent to your logic. This is where the deadliest mistakes are born. The first and most unforgivable is entering a trade without defining risk. Picture a soldier walking into battle with no armor, no plan, convinced he can improvise when the bullets start flying. That is the trader who buys or sells without a stop loss. The market never forgives improvisation. Without defining risk, you hand your survival to chaos. The second mistake is moving your stop. At the start, you place it with confidence, promising yourself that this time you'll be disciplined. But as price creeps closer, fear whispers, just give it more room, it will turn. You slide the stop lower, rationalizing that you're being flexible, but in reality, you've betrayed your plan, and betrayal is always punished. The third mistake is hesitation. You see the setup. Your system screams, enter now, yet your hand freezes. Fear of being wrong paralyzes you. The trade runs without you, and in your frustration, you chase, entering late, destroying your edge. Hesitation is not caution, it is paralysis, and it kills opportunity. Then comes its evil twin, jumping too early. FOMO whispers in your ear, get in now before it's gone. You leap into trades before confirmation, desperate not to miss the move. But trading is not about catching every wave. It's about catching the right ones. Acting too soon is as destructive as acting too late. The fourth mistake is cutting winners too quickly. At last, the market moves in your favor, but fear whispers again, take it now before they take it back. You snatch crumbs while leaving the feast untouched. Over time, this habit rots your edge. And finally, the deadliest of all, letting a winner turn into a loser. Greed and hope conspire together. You refuse to take profit, convinced the market owes you more. But the only certainty is uncertainty, and when the reversal comes, profit vanishes, and you are left with loss. Regret follows like a shadow. Here's a practice you can try right now. For your next 10 trades, don't track whether you were right or wrong on direction. Track only one thing. Did you follow your process? Mark each trade as either process kept or process broken. This simple shift will rewire your focus from outcome to execution, from ego to discipline. Because the truth is plain, these mistakes are not about skill, they are about psychology. Every trader knows better, but knowing is useless without the discipline to act. The amateur believes knowledge alone is enough. The professional knows execution is everything. And even when you see your mistakes, your mind is skilled at protecting you from the pain of admitting them. Defense mechanisms step in: rationalization, denial, selective perception. So you repeat the same errors again and again. Until you break the need to be right, you will remain trapped in this cycle. But once you let go, once you release the ego's demand for certainty, you discover freedom. You discover that success in trading isn't about being right, it's about being consistent. And consistency begins not with prediction, but with discipline. When the market wounds us, our minds rush to protect us. That is what the brain was designed to do: shield us from pain, soften the blows, preserve our sense of self. But in trading, these defenses don't save us. They sabotage us. They trap us inside cycles of loss, ensuring that the same mistakes repeat again and again. They are invisible walls, comforting in the moment but deadly in the long run. The first wall is selective perception. You glance at the chart, and without realizing it, your eyes filter out the evidence against your position. If you are long, you magnify every bullish candle, every upward tick, every sign of strength. If you are short, you fixate on every bearish pattern, every drop. The evidence that contradicts you is right there, staring you in the face, yet your brain refuses to see it. To acknowledge it would mean admitting you could be wrong, and your ego will do anything to avoid that. The second wall is rationalization. Your trade is bleeding, but instead of cutting it, you invent stories. It's just a pullback. The market is overreacting. This news doesn't matter long term. Your brain spins logic out of thin air to justify what your emotions demand. Every second you rationalize, you sink deeper into loss. Then comes denial, the rawest defense of all. Price slices through your stop, but you delete it. The market crashes past your level, and you whisper, "It'll come back." Denial feels safe, like a blanket shielding you from the cold edge of reality. But in markets, denial is fatal. It turns manageable losses into catastrophic ones. And when the pain sharpens, another defense rises: emotional hijacking. Fear floods your system, adrenaline surges, your rational mind shuts down. You are no longer trading a plan, you are trading your survival instinct. Every tick feels like an attack. You smash buttons, double down, revenge trade, desperate to erase the pain. In those moments, you are not a trader at all. You are a cornered animal. Finally, there is the frozen state. Losses mount so high you go numb. Your hands won't move, your brain shuts down, and you sit paralyzed, watching helplessly as your account bleeds. It's neither fight nor flight, it is surrender. A slow, quiet death of capital and confidence. But beneath these surface defenses live deeper saboteurs, beliefs about money and self-worth that were planted in you long before you ever saw a chart. These are the puppet masters pulling your strings. Some traders carry wounds of self-worth. Deep down, they believe they don't deserve success. When profits appear, they unconsciously sabotage themselves, overtrading, breaking rules, handing money back to the market because winning feels unsafe, unearned. Their account balance becomes a mirror reflecting old scars. Others wrestle with moral conflict. All their lives, they were told that quick money is gambling, that profit without sweat is wrong, even sinful. So when they trade, an inner war ignites. One part seeks wealth, another part feels guilt. Every win tastes tainted, every loss feels deserved. Then there is childhood programming. Perhaps you grew up hearing, "Money doesn't grow on trees. Rich people are greedy. Easy come, easy go." Those words don't vanish, they sink into your subconscious. So when trading offers abundance, your programming sabotages you. You cut winners short, you cling to losers, you hold yourself back because somewhere inside, money feels dangerous. And perhaps the most insidious of all, the twin fears of success and failure. Failure terrifies because it threatens your identity. Success terrifies because it threatens your comfort zone. What if you succeed and then lose it all? What if others resent you? What if success changes who you are? These fears keep traders in mediocrity, sabotaging breakthroughs before they happen. If you recognize any of these defenses in yourself, here's a tool you can start today. Create a defense mechanism journal. Each time you catch yourself rationalizing, denying, or filtering reality, write it down. Don't judge, just document. Then, list 3 beliefs about money you inherited in childhood. Not what you think now, but what you were taught then. Awareness is the first step to breaking free. Because here's the truth. Trading is not about learning the market. It is about unlearning your illusions. You cannot trade beyond your self-image. If deep inside you believe you are unworthy, inconsistent, or guilty, you will always trade in alignment with that story. The market doesn't just reveal your edge, it reveals you. Mark Douglas taught that honesty is the antidote. Brutal honesty about your impulses, your emotions, your beliefs, because what feels like protection is actually sabotage. And until you face it, name it, and replace it, you will stay locked inside the same cage. So ask yourself now, how many times have you explained away a bad trade? How many times have you blamed the market instead of your own hand? Those weren't harmless excuses. They were the walls of your prison. Tear them down and freedom begins. Because the truth is simple. You don't trade the market, you trade your mental state. Close your eyes and imagine a casino in Las Vegas. On the main floor, players grip the table edge, eyes glued to the roulette wheel, hearts pounding with each spin. For them, this one outcome is everything: life or death, win or ruin. But look higher into the glass office above. There sits the casino owner. He doesn't care whether the ball lands on red or black. He knows the math. He knows that over thousands of spins, the tiny house edge guarantees survival, guarantees profit. That is the difference between the gambler and the professional. The gambler lives and dies on one spin. The professional thrives on the series. Mark Douglas taught that every trade is random in isolation, but meaningful in aggregate. The amateur asks, will this trade win? The professional asks, if I take the next 20 trades according to my rules, will my edge play out? That question changes everything. It is the shift from gambling to business. A gambler chases certainty. A professional embraces probability. That mindset transforms trading from emotional chaos into structured consistency. Think of a system with a 60% win rate. On paper, that looks powerful, but in practice, it could easily lose 5 times in a row. To the gambler, those 5 losses feel like a disaster. Panic sets in. He abandons the system, convinced it no longer works. But to the probability-minded professional, those same 5 losses are simply part of the distribution. He doesn't flinch. He knows that over 100 trades, the math will lean back in his favor. He keeps going, calm, methodical, unshaken. Consistency does not come from controlling outcomes. It comes from accepting inconsistency. Every trader dreams of smooth equity curves, but real trading is jagged, uneven, filled with drawdowns. Yet within that chaos lies hidden order, if you think in probabilities. And this leads to the ultimate breakthrough, the carefree state of mind. Picture yourself walking into a casino with a pocket full of chips. You sit at the slot machine, pull the lever, and lean back with a smile. Why? Because you already know what most traders never accept. The outcome of this spin doesn't matter. It could be a loss, it could be a win, but either way, you are untouched. That is the carefree state. It is not indifference. It is not recklessness. It is freedom. The carefree trader is meticulous, disciplined, prepared. But once the trade is placed, he releases it into the stream of randomness with no emotional strings attached. He does not obsess, he does not pray, he does not demand validation. He accepts that uncertainty is the cost of entry. He has already paid that price. Think of a river. The amateur jumps in, thrashing, desperate to force the current to flow in his direction. The professional sits on a raft, steering lightly when needed, letting the current carry him forward. That raft is the carefree state. It lets you flow with the market instead of drowning in it. Here's a practical exercise. Write down your win rate. Then calculate how many losing trades in a row are statistically normal for your system. If you have a 60% win rate, expect at least 5 consecutive losses. They will come. Knowing this intellectually is one thing. Accepting it emotionally is another. Which one are you? Comment below with your win rate and how many losses in a row you're prepared to accept without breaking your process. The paradox is this: the less you need the market to give you, the more consistent you become. When you cling to outcomes, this trade must win, this level must hold, you tighten your grip and fear takes over. Fear of loss, fear of missing out, fear of being wrong. Fear leads to sabotage. But when you let go, when you accept randomness as the very air you breathe, you discover flow. Carefree does not mean careless. It means detached discipline. It means trading without emotional chains. It means shifting identity from gambler to house, from player to owner. The gambler gasps for survival on every spin. The house collects its edge calmly, patiently, endlessly. So let me ask you, how different would your trading feel if each outcome carried no emotional weight? If win or lose, you remained centered, focused only on your process? That is the professional mindset. That is the transformation from chaos to consistency. Because trading is not about being right on the next move. It is about playing your edge over the series. One trade is noise. 100 trades reveal the truth. And when you step into probability thinking, when you breathe into the carefree state, you are no longer at the mercy of the market. You are aligned with it. You stop fighting and you start flowing. A professional trader does not sit at the screen waiting for the market to confirm his ego. He does not waste hours building elaborate cases for why price must move in his favor. He does not wrestle with hesitation when the signal appears. The professional operates like a surgeon in the middle of an operation, calm, precise, mechanical. He has a process, and he follows it without negotiation. That process is what separates the gambler on the casino floor from the house that collects chips night after night. Mark Douglas broke this process into simple truths. First, the professional recognizes his edge. He knows the exact conditions that signal opportunity. He doesn't try to predict the future. He simply identifies when the environment matches his setup. Second, he evaluates risk to reward. To him, each trade is not right versus wrong, but cost versus potential payout. It is a business decision. Is the price of entry worth the possible return? Third, he executes immediately. No hesitation, no debate, no emotional storytelling. The signal appears, the rules are met, and he acts. Fourth, he manages exits according to plan. Stops and targets are predetermined. He doesn't improvise, doesn't plead with the market, doesn't drag a stop lower in hope. He honors the plan. Finally, he reviews and adjusts after a meaningful sample size. Not after one trade, not after three, but after 20, 50, 100. Because only then does the true edge reveal itself. Picture a pilot flying through turbulence. The amateur clutches the controls, jerking back and forth, reacting to every bump of wind. The professional keeps his hands steady, trusting the instruments, knowing the plane was built to handle storms. That is the difference. The amateur reacts to noise, the professional trusts the process. The truth is this: the market does not reward brilliance, it rewards discipline. You can be the smartest analyst in the room, but if you cannot execute your plan without hesitation, your intelligence becomes your downfall. The pro knows execution without emotional interference is everything. So ask yourself, how many times have you ignored your own rules in the heat of the moment? How often have you hesitated at the exact second your system told you to act? Those were not market failures. They were process failures. Until you honor your process above your pride, consistency will remain out of reach. The casino does not care who wins this hand or that spin. It only cares about running its process because in the long run, the process guarantees profit. As a trader, your job is no different. You are not here to be right. You are here to execute. And once you accept that, you can begin to build the skill that makes execution natural tests automatic, unshakable. You can train yourself from the ground up, closing the gap between knowledge and action until discipline becomes second nature. That is the mark of the professional. Not brilliance, not prediction, but consistency through process. Every trader dreams of scaling fast. Big trades, big wins, instant freedom. But the brutal truth, as Mark Douglas reminded his students, is that you cannot skip steps. If your psychology cannot handle one share, it will collapse under 1,000. The path to mastery doesn't begin with size, but with discipline at the smallest level possible. Execution must become automatic before size can grow. Think of paper trading. To most, it feels pointless. Fake money, fake emotions, fake results. But in reality, paper trading is a diagnostic mirror. It strips away excuses. If you cannot follow rules in a risk-free environment, what makes you think you'll follow them when real dollars are on the line? Paper accounts reveal the mental gap between what you know and what you do. Until you close that gap, live trading is suicide. Mark often told his students, start with 10 shares, just 10. Forget about making money, forget about getting rich. The purpose is to build trust in your process. Can you enter exactly when your system signals? Can you set a stop and leave it alone? Can you exit at your target without second guessing? These are the foundations. If you cannot answer yes with 10 shares, you will not answer yes with 10,000. Imagine an athlete learning to lift weights. He doesn't begin with 300 pounds. He begins with the bar, learning form, training muscle memory, building confidence. Only then does he add weight gradually. Trading is no different. Each small position is practice, each repetition wiring discipline into your nervous system. Gradual scaling is not weakness, it is wisdom. Perfect execution matters more than profit. In fact, profit at the beginning is irrelevant. Your only goal is to prove you can follow your rules flawlessly. Because once you can execute perfectly with 10 shares, you can do the same with 100, 1,000, 10,000. But scale too early and the market will expose every crack in your psychology. Those cracks will widen until they break you. Ask yourself, have you ever increased your size just because you felt ready, only to watch your discipline vanish the moment the stakes rose? Did you blame the market? Or did you see the truth? that your psychology was unprepared for the weight you placed on it. This is why Mark insisted on expanding your comfort zone step by step. Comfort is not laziness. Comfort is soil where discipline grows. Stretch it too fast and the soil tears. Stretch it carefully and the soil expands, holding more and more until one day you realize you are no longer the gambler clawing at the market. You are the casino, steady, methodical, patient. Here's a concrete exercise. For the next 20 trades, use the minimum position size your broker allows. Your only goal, perfect execution. Track an execution score, not profit. Did you enter at the right signal? Did you place the stop correctly? Did you manage the trade according to plan? Score yourself trade by trade. This builds the neural pathways of discipline without the pressure of money. Because once that foundation is built, you face the next challenge, managing the emotions that trading awakens and learning to scale your success sustainably. If trading were only about charts, anyone with a calculator could be a millionaire. But trading is about emotions, wild, unpredictable, overwhelming emotions that surge like tidal waves. And unless you learn to master them, they will master you. Mark Douglas warned, emotional management is not optional, it is survival. Consider euphoria, the sweetest poison. After a string of wins, you feel invincible. Nothing can stop me now, you whisper as you double your size, bend your rules, chase setups you'd normally ignore. But euphoria is a liar. It whispers that the market bends to your will, when in truth it is setting the trap. The fall from euphoria is brutal because it blinds you to risk until it is too late. Then comes overconfidence, euphoria's quieter cousin. It doesn't scream, it smiles. It convinces you that discipline is for others, not for you. Stops get looser, rules are ignored. You think you've evolved beyond basics, but the market humbles everyone. On the opposite end lies despair. After a losing streak, every trade feels cursed. You second-guess signals, you hesitate, you sit paralyzed as opportunities pass by. Losses seep into your identity until you feel like the market isn't just taking your money, it's taking pieces of your soul. Depression creeps in, whispering, maybe you're not cut out for this. And in the middle lies equilibrium, the razor's edge. The professional's task is to stand here, neither intoxicated by wins nor shattered by losses. Wins don't swell his ego, losses don't break his will. He accepts both as natural parts of the distribution. Like a sailor adjusting sails, he adapts without emotional collapse. How does one achieve this? Mark suggested reset techniques, simple, deliberate actions to return to center. Step away from the screen, breathe deeply, walk outside, review your plan, not your profit and loss. Remind yourself, one trade is nothing, the series is everything. These rituals realign your nervous system, pulling you back from extremes. Here is where scaling becomes critical. Trading is not only about entering the market, it is about knowing when and how to take money off the table. The amateur dreams of catching the entire move, of riding trends perfectly, but the professional knows this dream is poison. Markets don't reward perfectionists, they reward consistent harvesters. Mark often said, take the money the market makes available. Not what you hope, not what you demand, but what it offers in the moment. This shifts your identity from desperate hunter to disciplined harvester. One of the most powerful tools is scaling out. Instead of holding the entire position until the bitter end, you take partial profits along the way. At first, this may look like weakness, but psychology is the true benefit. Each partial profit locks in success, reduces fear, and builds the identity of a consistent winner. With each scaled exit, you're telling your nervous system, see, I can win, I can protect, I can follow my process. That reinforcement is priceless. Consider Douglas's silver futures trades. He would enter, scale out as price moved in his favor, and leave a runner to capture potential extended gains. This way, he never depended on fantasy tops or bottoms. He secured profits along the way, balancing realism with ambition. The wisdom here is profound. Scaling isn't about maximizing every dollar. It's about maximizing longevity. The professional doesn't measure success by one trade. He measures it by how many trades he can take consistently over years without blowing up. Scaling protects the account and the mind. Here's something you can implement today. Create a 5-minute reset ritual. Step away, breathe 10 times, review rules, and remind yourself you're playing a probabilistic game, not a predictive one. For scaling, try the rule of thirds. Scale out 1/3 at your first target, another third at your second, and let the final third run with a trailing stop. Balance consistency with possibility. Now ask yourself, how many times have you watched a winner evaporate because you refused to take partial profits? How many times have you sold everything too early only to watch the market soar without you? Both are imbalance, fear on one side, greed on the other. Mastering emotional management and scaling builds more than strategy. It builds a winner's mentality. When you master these, trading stops being a desperate grab for pennies. It becomes a disciplined practice of harvesting, like a farmer tending crops season after season. And that prepares you for the ultimate challenge, recovering from trauma and integrating everything you've learned into mastery. Every trader carries scars. Some are small, a string of bad trades, a frustrating month, a missed opportunity. Others are deep, an entire account blown up, a fortune lost in one reckless night, years of effort erased by one catastrophic mistake. These traumas don't simply fade, they live in memory and in the body, resurfacing each time you open a chart. Unless you learn to recover, those scars become chains that keep you from ever trading freely again. Mark Douglas spoke of the gutter principle, that some traders must hit rock bottom before they truly change. They must lose everything before they release illusions, ego, and denial. But trauma doesn't have to be your teacher through destruction. You can face lessons now without burning your life down. Trauma can be the wake-up call, but it can also be the catalyst for transformation. Picture a trader who built his account to 6 figures, only to lose it all within weeks. Shame suffocates him. Friends whisper, family judges, he swears never to trade again. Yet later he returns, not chasing glory, but following process. Slowly, carefully, he rebuilds. His scars become wisdom, his discipline unshakable. Trauma can kill you, or it can carve you into something stronger. The first step is learning without self-destruction. When you take a loss, resist collapsing into shame. Extract the lesson, write it down, own it without judgment. Losses are not personal, they are tuition, but only if you study them. The second step is rebuilding with humility. Start small. Begin again as if you were a beginner. Shed the weight of your old identity. You are not the blown-up trader, you are the student now. Humility creates space for growth. The third step is redefining identity. You are no longer someone trying to win. You are a professional in training. Each trade is not a test of your worth, but a practice of process. With this identity, consistency becomes inevitable. History is full of traders who fell and then rose again. Jesse Livermore made and lost fortunes multiple times. Many modern fund managers once sat in ashes of failure. What separates those who rise from those who quit? They transform trauma into discipline, not into excuses. And this leads to integration, the final stage. Mastery is not a destination where losses disappear and charts obey your will. Mastery is a state where psychology, process, and intuition merge into rhythm. It is the moment you stop fighting yourself and start flowing with the market like a surfer riding waves he cannot control but has learned to read. At first, you trade mechanically, rules, checklists, rigid structure. This is necessary because structure tames chaos. But over time, as discipline becomes habit, something shifts. You begin to sense rhythm beneath price, intuition awakening. Intuition is not impulse, it is the subconscious expression of thousands of disciplined repetitions. Integration requires more than intuition, it requires simplicity. In a world drowning in indicators, news feeds, and data, the professional knows more information doesn't mean clarity. It means confusion. Mastery is subtraction, cutting noise, keeping only what serves the edge. Simplicity is power. Another pillar is personality alignment. The master doesn't force himself into a trading style that conflicts with his nature. Scalpers who hate pressure break. Swing traders who crave action sabotage themselves. Mastery means aligning method with temperament so trading flows with who you are. The amateur obsesses about the next trade or week. The professional thinks in decades. He asks, can I still trade this way 10 years from now? Can my psychology, lifestyle, and beliefs sustain this process for life? Mastery is built for endurance. The wisdom bomb here. Mastery is not about control. It is about harmony. Harmonizing rules with intuition, simplicity with depth, ambition with sustainability. No longer swinging between fear and greed, euphoria and despair. Instead, you find steady rhythm. You become both casino, patient, consistent, and artist, attuned to flow. So, what story are you telling about your losses? Are they proof you're not cut out for this or proof you are being forged in fire? Have you been chasing mastery as a finish line? Or can you see now that mastery is a state of being, a daily practice of alignment, a continuous evolution? The liberating truth: you don't have to wait for mastery to trade like a master. You only have to begin living these principles now. The market was never your opponent. It was always your mirror, reflecting your fears, exposing your denials, amplifying your beliefs. And in that mirror, the only truth that matters emerges. Consistency is not about conquering markets, it is about conquering yourself.